Gold soaring to new heights today. It rose more than $10 an ounce in New York trading. It closed at $1,438 an ounce. Also, oil, it moved higher. That leaves some difficult decisions for commodity investors. Should they take their profits now, or should they hold on to those gains and let it ride? Let's get some perspective now from John Stephenson. He is a fund manager at First Management Assets. He is also the author of The Little Book of Commodity Investing. John Stephenson, good to have you with us. So what do you make of this rise in the price of oil as well as the price of gold? Let's start with gold first. Do you hold on, or do you take some profits?
Well, I think, Pimm, in both the case of gold and oil, you hold on. I think commodities will be your best investment choice for the next decade. And frankly, when commodities are doing well, pretty much everything else in your portfolio isn't doing so well. So it's a great time to be a commodity investor. And I think you'll see gold hit $1,700 this year, and probably oil will bounce up around $150 when it's all said and done towards the end of this year. So I think
$1,700 an ounce for gold this year, and $150 a barrel for oil.
Absolutely. I think what's driving it is really the same principles. Certainly in the short one, what's driving oil and driving gold is all the uncertainty in the macroeconomic environment. Obviously, you just led off with a story about Portugal, and that's huge. In times of uncertainty, people want to hold gold, which has historically been a safe haven. And oil is something that we believe that we're running short of, and certainly the problems in Libya don't seem to be going away, and the repercussions and the possibility of it spreading into Saudi Arabia are huge.
But, John, what's so uncertain about the global economic outlook? The economy in the United States is doing better. We hear almost on a daily basis that emerging economies, they want more of everything, whether it's washing machines or indeed manufactured goods and services. Why this uncertainty?
Well, I think in the case of most commodities, it is the fundamental supply and demand. And you're absolutely right in pointing out that the developing world, which is 4/5 of the world, the Chinas and the Indias, want all the things that we have in the West, and they're going to get it. And that underpins the demand for oil, copper, zinc, aluminum, nickel. And in the case of gold, it also has some of those same properties, but it also trades as a monetary instrument. And people are very concerned that some of the recovery in the United States, and to a lesser degree Europe, has been engineered by central banks who may be printing money. And you know, when you have situations like the situation today in Portugal where the prime minister is resigning, it underscores the fact that, hey, maybe we're not out of the woods yet, and maybe we better hold on to something tangible and real and something that can be taken across borders.
All right. Well, we're looking at things that are tangible and real. Big gold bars, for instance. Do you buy gold bullion? Do you buy gold coins? Or do you buy an ETF, an exchange-traded fund that moves in lockstep with the price of gold? Or should you buy the shares of gold mining companies?
Well, I think if you look at the last number of years, gold mining companies have underperformed the metal. And I think it's set up a situation where some of the bigger companies could outperform. And I would point to Kinross, for example, the company that's badly lagged, but it should perform quite a bit better than the metal over time. And possibly Barrick as well would be two names that would come right to mind. But in general, I would say either the larger cap miners or an ETF that's physically backed like the GLD. Buying coins and bullion, you tend to take a haircut anywhere from 10 to maybe 20%. So it's not such a good investment. And then you have to consider the fact that you may be storing them as well.
John, what's the best way to speculate on the price of oil? Do you buy an oil producing company, or do you go with an oil service firm? What's the best way to get that price appreciation?
Well, I think for my money, the way to look at it is to invest in an oil service company. And the reason for it is pretty simple. If you look at what's happening in the world of oil production, we're going to smaller fields, further away from the shoreline, deeper. And that means they're more technically challenging. And the people who really have the expertise in this business are the Halliburtons and the Schlumbergers. Great ways, or the Baker Hughes, all great ways to play this rally in oil.
Now, would you be focused on the oil companies that are in Canada, for example, or the United States, domestic producers? Where geographically do you go looking?
Well, if most of the oil in the world is held by foreign governments, many of them, like Venezuela, who aren't exactly the most accommodative to Western oil companies. And so I think what it means is you're going to benefit by a higher oil price environment with the service companies, A, and then B, with the Canadian oil sands producers like the Suncor, the Canadian Oil Sands, which is really an oil bond in many ways, and the Canadian Natural Resources. All those are great names to play the rise in oil because you have that 45, 50-year reserve life where the majors have on average 12-year reserve life, so pretty skinny reserve life.
And I would imagine that the higher price of oil makes it more advantageous to be spending money to get oil out of things like the Athabasca oil sands in Canada, Western Canada.
Oh, you're absolutely right. Obviously, it's a high-cost area, sort of on average around $40 for the existing projects a barrel. And some of the new projects can be $60, $70 a barrel for new construction. So that starts to get up there. And that's why when you're getting up to $105, all of a sudden the economics go from marginal to outstanding. And again, you've got that long reserve life. So it's huge when you have you're producing and you have relative stability of production for 40 or 50 years.
Silver. What do you think is going to happen to the price of silver? It has moved up much higher in the last couple of months, and many investors say that this could even outpace the gains that we've seen in gold.
Yeah, I think it really could. I think it's had a tremendous run, as you point out, but I think it's going to go higher. And I would say it's likely going to exit the year at $50 or north of it an ounce. And the reason is pretty simple. Generally speaking, silver and gold move in lockstep. And silver's badly lagged gold. Gold has been the best performing commodity over the last decade, and I really believe that silver will potentially be the best performing commodity over the next decade. It's a much smaller market than gold, and so it's some of the same forces drive it, as do the gold market, but also it has better fundamentals.
What do you mean by better fundamentals? Industrial use?
Yeah, well, gold is really only used as a currency or a currency surrogate. It's used in jewelry. All those same applications apply for silver as well, but it has much more in the way of industrial applications. It's the best conductivity of any of the metals, so it's used in a lot of electrical connections, and it's used in medical applications as well. So it has a lot of fundamental support for its industrial uses.
All right, so you're bullish on silver. You think it could hit $50 an ounce this year. Tell me about the other industrial metal that's widely traded. It was up almost 3% today. That's copper.
I think it's the best of all the base metals or industrial metals is copper. Really a phenomenal metal. And the reason is very simple because it's in deficit. And Barclays came out, I believe, today and said that they expect the market to be in deficit this year by around 800,000 or 900,000 tons out of an 18 million ton market. So a fairly significant deficit. And there's really no new visible supply till 2014 or at the earliest, the last half of 2013. So a lot of mine life issues, and new mines are just slow coming on. So I think you're going to see this metal go higher.
So, John, there again, how do you invest in silver and copper? I mean, do you go out and open a futures account? Do you buy an exchange-traded fund that specializes in tracking the price of those metals? Or do you invest in a mining company?
Sure, I think great point. I think for most people, investing in a futures account is just too difficult to do. I mean, there's a huge amount of language that goes along with it, and I think, frankly, you're competing against the various banks and their desks who have more information, will probably eat your lunch if you do go out and compete. So I think in the case of silver, I would buy an ETF. SLV would be one I would look at. In the case of copper, harder to do that currently. But I would suggest Freeport is a great way to play. It's a phenomenal company, and I think it's going to go much higher. And it recently had a 2-for-1 stock split, so it's I think it'll be a $65 stock pretty soon.
John Stephenson, turn your attention now to the dinner table. Everyone getting a little bit hungry. Mm-hmm. What about agricultural commodities, whether it be corn or soybeans or wheat? Are we going to see those prices move higher this year as well?
I think you'll see them move modestly higher. We had a very big run last year. I'm not quite as bullish on those going forward, simply because we had such a strong run. Harder to play it unless you want to play the futures, which I don't recommend for most investors. But if you do want to play this cycle, which is driven in the longer term by more mouths to feed in the world and increasing protein in the diet, then the fertilizer stocks like Agrium, CF, Mosaic, those would be all ways I would play it. And I do think they'll generally go modestly higher this year.
John, what about some of the other soft commodities like cocoa? There is obviously violence that continues, civil unrest in the Ivory Coast, a big exporter of cocoa. And we've also seen coffee prices move higher. Kraft, for example, last week increasing the price of coffee. What's the outlook for those commodities?
Yeah. Well, I think in general, for most of those agricultural commodities like cocoa, I would say it's higher as well. I think that looks promising as well. Coffee, certainly that way. Sugar, less so. India just announced they're going to export more, so it's actually following that price. So I would say in general, it's looking higher. The other way to play the food theme is through the food processors, the crafts, as you mentioned, the General Mills. But remember that higher prices for these raw materials mean lower margins for them, so I would tend to avoid those companies.
And John, last question. How much of the rise in commodity prices is due to the decline in value of the U.S. dollar?
Well, it's hard to put an exact number on it, but I would say a certain percentage, probably less than half, maybe on the order of 15 or 20%. Certainly, it's a factor that people are factoring in, particularly in the case of gold and silver. I think it would be a larger proportion than that. But in most of these commodities, what simply drives them in the long run is supply and demand. And in most cases, we have far too little supply, and demand is absolutely voracious, and so prices are going higher.
All right, we're going to leave it there. I want to thank you very much, John Stephenson of First Asset Management and the author of the little book of commodity investing.